Sorry, last minute swiggle wine.
Needed after that.
We're live. Apologies, everyone. We had a minor technical difficulty at the end there. Welcome. This is our most popular webinar yet. And like we just talked beforehand, I've got a bit of an intro and I will get through it, but it is always awkward when you are sitting there waiting to say hi. So what I thought I'd do is introduce Darcy. Darcy is the host of the New Zealand Everyday Investor podcast. You may also recognise him from several Hatch events. He owns a boutique financial advice firm based in Freeman's Bay, which is where we're at now, having technical difficulties. But he remotely conducts meetings all over the world, including the South Island, which is quite far.
Right.
It's probably one of the most far-flung places we can get to at the moment. He invests in property, individual shares, managed funds, businesses, and crypto. And he assures me and has assured the whole team no topics off limits. So welcome, Darcy.
Thanks very much.
And I thought we could start with a quick, 2-minute rundown of what's your investing history.
Okay, thanks very much, Natalie. So in terms of my history, I probably would consider myself as someone who was a little bit late to the party in terms of figuring out maybe I should actually be doing something with my life outside of property. So apart from owning our own home, maybe about 15 years ago or so, we bought some investment properties when we were able to. And then probably only about 4 or 5 years ago, started to invest a little bit more seriously outside of KiwiSaver that I already had set up. And I've been slowly building up my little satellite portfolios, I guess you could say, around the edges of what I already did. So yeah, and that's kind of it in a nutshell. And doing the investment podcast is such an easy way for me to do my own research.
Sure, yeah.
So it's a bit of a selfish cheating way of doing this, but that's kind of my history in a nutshell.
Interesting. Yeah, I think we're kind of similar. So a little bit about me, just so you know that we have any right at all to be here, which sometimes I don't think I do. So I bought my first apartment when I was 24. It feels like I was older, but I did the maths the other day and I think I was about 24. It was a long time before the property market in Wellington went crazy. And then I very soon after bought zero shares. So I think I just bought my property.
And when you say zero shares,
like in the IPO,
XCRO,
in the IPO. So I invested on both at the same time, basically, which is probably unusual. Since then, I upgraded to a house from an apartment, and I had a great mortgage broker who told me to rent out my apartment, which introduced me to the concept of property investing, and then combined forces with my sister, and now we have built a little bit of a property, we call it a property empire of two. And then obviously working at Hatch, have built a fairly extensive share portfolio too. But my current focus is actually trying to figure out how to make them work better, because I think, like most New Zealanders, I have always thought of them as two separate investments, and that's sort of one of the biggest misconceptions that we'll probably be talking about a bit tonight, is that there's really one right or wrong answer and you're one or the other. And we do that with a lot of things in life, but I think quite often these things end up being, you can be a little bit of both. And I think especially in the last 5 years in New Zealand, there's been a huge change to the investing landscape. So we thought, which brings us to why we're here tonight, it's time for less of a property versus shares debate. As a whole, how do they work? How do they work for you? How do they work for me? And I think, Darcy, you nailed it in your newsletter the other day. It's actually not about comparing the different investments. It's about comparing how they work for you in different situations. So this is going to be an open conversation, and this is the first time we've done this not on my couch. There's no cushions. I was like, we have to have a decoration, so we've got some wine. And obviously one little thing here, because that was something that people raised quite early, is that Hatch obviously provides access to US share markets. But what we're at the moment, we're about to do a whole lot more. But we're actually really about giving you control over building long-term sustainable wealth. And we want to be here in 20 years and make sure that we're giving you all the ingredients now so that you're successful in 20 years, not force you to buying and selling shares in the short term to maximize our revenue, which is why this won't be your traditional I'm fighting shares, Darcy's fighting property. So we've got a couple of rules before we get cracking. This isn't about winning. We're not going to be fighting each other. In fact, just before Darcy was like, I'm not sure if we're going to fight enough. It's about finding the best options, so we'll probably swap sides. It's on you guys to fuel the debate. We have a bunch of questions. I hope we know the answers to. But there is a live chat underneath the video, and our wonderful team at the Hatch office is sharing those questions with us, and I've added all the questions people have already asked, so we'll be answering them. And weirdly, none of this is financial advice, and weirdly in that Darcy is in fact a financial advisor, and we were just talking about how that works. But basically, the only advice that we will give tonight is that it's a terrible idea to blindly follow anything that one person tells you without really understanding how it works in your situation. And obviously, we both flew here in private jets because we are exceptional investors. But just because we are so amazing at it doesn't make us gurus. We are just two people who have fairly strong opinions. And so, yeah, that's us.
Fantastic.
Great. Let's get cracking. First question. It's a goodie. Yeah. Should we be debating this?
Probably not, right? Probably not, because we probably, like you say, we have pretty strong opinions, but when we're preparing for this, it seems like our opinions are pretty closely aligned. And I think clearly it's not either or, it's what's right for you. And it's kind of like naturally, like what you were saying before, we typically like to put this in a sort of binary setup where it's what's the good thing about this one? What's the good thing about that one? Let's just choose the best investment. Let's back the right horse, the right vehicle. Yes. And we completely forget that it's about the rider on top of the horse, about yourself and where you're at that moment in time. Because I know for me personally, it was really naturally quite easy for us to buy our own home. And it was really quite natural then to buy our first investment property. But it wasn't a natural move to move into buying shares for me. And if I don't know, like if I waited until I had the right answer because I figured out what that right horse was, I don't know if I would have actually got anything done. So
yeah, you distracted me with talk of horses because now I'm dressage Olympics, gold medal today. Gone down that path. But no, I completely agree. I think that I always say this, and I say it more and more. I think that it's not either or; it's the option that gives you the best opportunity to sleep at night. And I think for me, both came. I suppose actually shares came more naturally because I run my own company, and I kind of knew how it worked with shares, whereas property. That was like, it sounds all fun and games until the moment you have to put more money than you've ever seen in your life on the table. Yeah. And that, but I definitely think it is very much it isn't an easy. So on that front, how they work together, should you pay off your mortgage before investing in shares?
I love this question because I think that we often don't look at our mortgage as an investment, but it kind of is in the sense that you're putting money towards it. I'm assuming you're making your regular payments, but let's say you decide to pay off your mortgage even more aggressively. That's kind of like an investment, right? And what you're getting is savings in the form of interest that you're no longer paying. So it's kind of like a proxy for a return on investment, and it's risk-free. So should you pay off your mortgage before investing? I personally don't think so. I kind of believe in simultaneous rather than sequential, because obviously we need time for all these investments to cook. And the longer you're cooking, the better it is. And shares, I view shares in my mind as a bit more volatile. It's going to go up and down in value. Probably a bit more aggressively. Yeah, we'll get to myself. So that's why I think it's good to kind of do both things at the same time, because you really want to get some exposure in shares soon, in my opinion, because then that gives you an opportunity for that magical compounding thing to happen sooner.
So you're saying don't pay off your mortgage first. I would say, again, whatever helps you sleep at night. I know people who are fixated on paying off that mortgage. And I think we both know people maybe who have done that and then maybe regretted it because they realized the opportunity cost. One thing that I found really helpful, and I just forgot until you were talking then, that my sister taught me is actually one thing that is almost the wrong question to ask. And what she did, and I just noticed because Gemma asked about what's your magic number to retire at 65. And that's something that my little sister taught me, is rather than talking about how much mortgage you have left to go, she actually created a very simple net worth calculator. And so by having sort of your property, your shares minus your mortgages, and we now both update ours every month. And every month we're looking at how is our net worth increased rather than how much is our mortgage decreased or how much is our share. So it doesn't actually matter anymore if it's a decrease in mortgage or an increase in shares. The actual number is my net worth growing, and rather than which one is the right option, because I think that gets you a little bit more fixated on.
You're right, on the thing that's actually valuable.
Yeah.
Which is wealth,
Yeah.
rather than the thing that's negative or the tool that's building the wealth, which is the debt.
Yeah.
And I think a lot of it comes from, I'll throw the older generation under the bus if I may, just gently. It'll be a very light bus, a little bit of bump. But I think a lot of the older generation is somewhat responsible for kind of teaching us that you should get a mortgage, get your own home, get that debt gone as fast as you can, and then invest.
Mm-hmm.
And it's not inherently evil. It's not wrong. Like, I can think of worse things to do, but it misses that compounding effect, right?
Absolutely.
Like, it's a huge opportunity cost, and it's a little bit more visible now. And it's easier probably for people to get that now because of where interest rates are so low. But the dynamics have kind of always been there.
Mm-hmm.
That interest rates are often a little bit lower than the returns that you can get in shares. Not always, but often.
Mm-hmm.
And so I think there does need to be a bit of an awakening here, and a bit of a paradigm shift, that it's about growing wealth, not about just getting rid of debt.
Absolutely. And I think the other thing that we talk about a lot is that lotto example of one thing that I found, and I paid off my apartment mortgage and celebrated for about 20 minutes before having a panic attack. And you spent so long trying to hit a target, and then suddenly I realized I was going to have this income that wasn't going to pay off the mortgage, and I didn't, other than the kind of buying a few shares here and there without thinking seriously about it, I was now going to make these big decisions in this investment area that I didn't understand as well. And so that's one thing that I learned from that, is next time I got a mortgage, I made sure I continuously built my knowledge of shares, so that when I did end up with larger sums of money, I knew what I was doing. So there's sort of the secondary benefit of that. And I suppose on that note, we talked about mortgages, and we are going to switch this around between shares and mortgages, and so far we haven't fought. But New Zealanders, we do often talk about our obsession with property. Are we obsessed with property, and is it a bad thing?
Oof. I think a lot of this language, right? Like, is there a housing crisis? Are we obsessed? Is it unfair? Is it fair? Like, a lot of this stuff, I think it's interesting. It's useful, I guess, to kind of frame discussions, but I don't know if it's entirely useful to start forming investment decisions when you start using language like that, because it kind of gets you off onto a tangent which isn't really super relevant. But I think, going back to the question, are we obsessed with property? I think maybe to a certain degree we are, and it comes largely from potentially from our family, and not just our parents, but our grandparents and their parents, who were possibly, for most Kiwis, the first people to come to New Zealand. And
absolutely, yeah.
For me, like, I don't sound like a Kiwi, but I am, I promise. I've been here for 25 years, and for us to come here, it was a bit of a thing. We actually didn't necessarily have to fight to get here, but we really had to get here. It was an effort.
It's a decision you have to make. You don't land here by accident.
No, I wasn't born here, right? So there's something about that, right?
Yeah.
Like, that's quite fresh in my memory, because I physically did it. But for a lot of us, it came from our parents and our family, and I think that creates a certain sort of ethos within our families, within our culture, where there's a sense that we want to grab land because this is the new frontier that our generations moved to. And so naturally we want to own it. And so there's a little bit of that's going on. And I don't think that's necessarily unhealthy in the context that New Zealand is the best frickin' country in the world.
Absolutely.
Bluntly.
I mean, as we know.
Totally.
But yeah. I mean, I would question, the only thing I'd question with that, because I think that's a really good point, that we are, I think you're sort of saying pioneers, and we still have that mentality of sort of finding land and setting up roots. I mean, it's not a very old country. But one stat that I found very interesting recently is, and this is from the Financial Services Council, which blew my mind, is that 13% of Kiwis own an investment property, 13%, versus 30% who own shares. And a year ago, that was 20% who own shares. So I almost disagree that we are obsessed with property. I think there's a lot of myths, and that whole thing about the landscape's changed in the last 5 years is that actually we keep talking about us all being obsessed with property, but about a third of the number of people who own shares own an investment property. That's separate from having your own house. There's a lot more who own their own house that they live in. But yeah, I feel like, and then the second thing about the obsession is that the idea of this property investor is a bit false. Like this idea of, and I've been in this position when I bought an investment property, and it was pretty rough. Someone sold it to me, but they were really annoyed that they were selling it to me as I was a property investor. And my sister was like, it's just me and her. Like, we're just trying to do this one thing. And most, I think it's like 60% of people who own an investment property own one or two. It's quite different from that notion of someone who owns 50 of them. Changing a bit. Houses, they're tangible. Like it, and is there something important in that? We buy houses, we invest in property because it's for our future, it's our retirement, it feels secure and tangible. Is tangibility important when it comes to investing?
I think so, insofar as that it helps you to get triggered emotionally in a weird way, right? Like I know that there's probably the sense that you shouldn't bring your emotions to investing, but I kind of view emotions as a really useful booster rocket to get you into that atmosphere of making a decision. And I know personally, anyway, with our property purchases that we've made as investments, it was far easier to make that decision because when you physically put yourself in a position at an open home,
yeah,
there's something that happens. Like you're actually inside of an investment. And I think that's quite an interesting thing. And it's a little bit different. It's not necessarily off the charts different, but it's a little bit different when you're buying shares in Nike. Yes, you could literally put your feet into those shoes,
be
right?
An investment.
Yeah, you could, I guess. But I think there's something in that where I think a lot of people, when they look at shares, they're looking from a financial mindset, and it's all intellectual and it's all numbers, and they feel sometimes a little bit daunted, like put off by that. Does that make sense? Whereas with property, it's a lot easier for people to make a move, especially in the context of a couple when they're making a joint decision, because often one part of that couple might be more led by emotions than the other. And in the you can't see that. But when it comes to shares, often it's the analytical person who takes charge, and then the other person is like, well, I can't be stuck. You make the decision if you're going to do that. You know what I mean?
Yeah, and I can't tell if I completely disagree with you or the status quo, because I think while houses are tangible and it gives you that feeling, I've had that feeling. You walk in and you feel like this is a living, breathing, it's not living, feels solid, feels substantial. Companies also are, and I think that example of walking in and being in an investment, I feel that when I walk into when I could go overseas into an Apple store or to a Levi's store, I'm in this company that has tangible products, that has employees, that has business practices, culture. It is so much more tangible. And I think, and to your point about one side can often be emotional, I actually think we're starting to see that a lot more with shares. And that's actually, I think, a thing that we'll continue to see over the next few generations, hopefully, is it used to be 5 years ago, shares used to be the realm of the sort of very literal, analytical, numbers, maths world. And now I notice amongst my friends, their investment decisions are very much based around having, and it's not just having a conversation. It's not just me and you going, oh, I think that's like Nike's good. Someone's read an article, they've done some analysis, there's a debate about it, and people feel passionately about that brand. And so I feel like we're starting to see a change from that houses are tangible, shares are these like weird widgets that you can't really put anything on, to like, I feel a part of this company and I want to be part of their success.
And that's something that I was late to figuring that out. I think that's my issue. But I think that's probably something that a lot of people face when they enter into shares is just making that switch. But it is important.
Yeah, you have to do it.
Yeah, emotions are important. Unless you bring all of yourself to this task, it's not the same, and you're not necessarily going to get the same results.
No, you won't. If you investigate both investment options differently, you will get different results.
Yeah.
Okay, next question. I'm going to try and keep these rapid-ish fire because we're 20 minutes in. 13% of New Zealanders own an investment property, but 64% own their own home. Does your own home count as an investment?
Cool. This is a good one, and I'd love to disagree with you here, but I can't. I know what you're going to say. I know for a lot of people, their own home is their investment, and that is how they view it. And I think, and I'll come back to that, I think there is actually some logic behind that, and I think that is a valid sort of way of framing it for some people. However, I think that we have to live somewhere, right? We have to live somewhere, and that shouldn't always be an investment. It shouldn't be technically an investment. Your investment property should be, and your shares should be, and your other things should be, because if you liquidate those, if you sell them, if you change it up, it actually doesn't change your life. You don't have to change where your kids are going to school.
Mm-hmm.
You don't have to smell paint every morning when you wake up because everything's changing all around you. So I think where it's kind of almost allowable, if I could suggest that, is when there is a clear strategy in place to maybe downgrade. Let's say you own a really nice home in a city center and you're growing up your family in there. And as you approach retirement, you retire, the kids move out, it's time to downgrade your home, repay any residual debt, if any, and then you buy a lower value home, release some equity, which you then invest elsewhere for your retirement provisioning. So in some cases, there might be a rationale for that. But I think where it gets a little bit dangerous is when people give up on investing anywhere because they just assume that, well, all of my equity is in the home. That's my strategy.
Yeah, I completely agree. I agree. No, I would say no, it's not an investment. And I would say even that example of downgrading when you retire. My parents, hi mum, she's watching, I think, they have a big 4-bedroom family home and they look to move to a smaller home. But the thing that I think people discount is when you retire at 65 these days, that's young. That is young. You've got a lot of life left to live. So part of that is you're not buying a small house next door to the big house in the same place. You want to move closer to town. And so actually what they found is they were going to spend more for less to get what they wanted in their new life. And I think they'd initially thought, we'll retire somewhere quiet. They don't want to move somewhere quiet. They want to move closer to the action in their retirement so they can get out and about. So I think you have to seriously consider, is that actually a good strategy? Versus, and this is where I feel like shares have a solid one here, is when I sell my shares, I don't need to buy new shares to live in. I will sell my shares and I will be able to buy shares in a totally different industry if I want to, or any other thing that I want to buy. Whereas my private home, I just would consider you need to have a home to live in, and if you're not paying another house, you're paying rent.
Yeah.
On that front, property is now considered unaffordable by a lot of people. Does that make property overpriced?
Probably say the same thing with shares, right?
You could. Yeah, we've had, a bull market for 10 years. When we launched Hatch, people told us shares were overpriced, and and that was 3 years ago. And I hope those people didn't follow their own advice.
And just to be clear, just because something might feel overpriced by some metric doesn't necessarily mean that it is overpriced. It's just that the number feels scary. But we're living in a world where everything is kind of floating upwards. And so there's all this relativity that you need to factor into it. But the two areas around the affordability piece, and this is, I guess, in the context of property investment rather than your own home, perhaps, but is the hurdle to get in, right?
Absolutely.
Because you need to, if you're living in your own home, you need to come up with 20% deposit if it's your first home. And if you're buying an investment property straight off the bat, which is unlikely, normally it's after your own home, you have to come up with 40% deposit. And that's a huge amount of money. It's massive to save that. So in the context of the deposit, yes, it's ridiculously unaffordable. But from servicing point of view, once you're in and you're actually just doing it, it's actually not that expensive. When you look at what incomes were, say, for example, in the 80s relative to today, and the interest cost as a proportion of your income back then, it's actually not a lot different. So from an affordability point of view, no, it's not actually unaffordable. But from the point of view of getting into it, yes, it is.
No, yeah, and I think I agree and disagree. And as we're going through, I'm starting to feel like maybe we will be debating more than I know. Because I think on top of that unaffordability of getting in is I have tried to buy properties in Wellington. Our housing stock is in abysmal state. I don't know what Auckland's is like. That not only is it the cost of getting that 40% deposit as an investor, but people have let these houses go for way too long. And with the Healthy Homes Bill, which I know a lot of property investors don't feel super amped about. I do. I am a landlord who believes very strongly in healthy homes, and I think to bring up the houses that I've looked at to a standard that I would be happy to rent out is a fortune, and I'm already paying that. So I think there's that versus if I want to buy shares, even in a very expensive company, the barrier to entry, if we're talking about the deposit, I can start with a very small amount, and then the maintenance. Don't have to pay maintenance on shares. So immediately, I think if we're talking about affordability, I would say shares is a clear winner.
Yeah, absolutely. And I think that there's also a little subtle nuance there to point out, is that when you're a shareholder in a company, you're a part owner in a business, right? And that business is actually designed and structured and operated as a business. They've thought about all these things, the human resources, the maintenance on their buildings, all that.
Yeah, they can cover all that stuff.
Yeah, they can, and it's spread out over a massive operation. Whereas when you're a property investor, it's all on you. You own the entire business.
Yes.
And therefore you are a lot more susceptible to those costs, like bringing it up to standard.
Yes.
And those standards can change.
Absolutely. But on that note, so because as we're going through this, I do feel maybe I have a slight slant towards shares that I hadn't identified. But there is one big obvious benefit to property that I think a lot of people who are listening have recognized and probably screaming out. Leverage is a property investor's best friend. And leverage is a word that's, like many words in investing, that's thrown around a lot. And I've just seen a comment about negative gearing, and I think it's another one, and we can talk about that hopefully soon if we can get through all the questions. Can you explain, firstly, what leverage is? Because I think while people talk about it a lot, it may not be something that everyone knows. So in a really simple 1 minute, what's leverage when it comes to property?
Let's see if I can come up with something on the fly like this. So think of a lever, right? A little bit of effort gets multiplied and creates a bigger outcome than the sum of its inputs.
Mm-hmm.
So in the context of property investment or owning a home for yourself, for example, you're using other people's money. You're using the bank's money to increase your exposure into that asset so that you show up with, say, for example, $1 million purchase price. You show up with $200,000 of your own deposit, 20%, and the bank shows up with $800,000. So your $200,000 that's your skin in the game. But any gains or losses that can both happen get applied to the $1 million mark. So that's the magic of leverage, is that in an upward market, especially over the long term, you win because your efforts and your exposure is being multiplied by something that isn't dependent on you. Mm-hmm. Does that make sense?
I think it does. I does. So. If everyone let us know if it doesn't make sense, but I think,
and if it doesn't, just Google it, right?
Yeah, you can just Google it, and it's a very, very powerful thing, a very, very powerful advantage to investing in property. So then, I suppose one of the top questions we've been asked is, how do shares combat that giant bonus that you get from being able to invest, nothing in a property and having that other people's money growing the value of that property? How do shares? Yeah.
So there's a couple of different ways, right? Like there's some platforms out there will allow you to actually use leverage when you're doing, but that's more trading, and that's probably not the context of what we're talking about here. Every time you are, let's say you own a property and then you're trying to build a share portfolio, every time you make that active decision to, instead of repaying your mortgage more aggressively, you decide to put it more into shares, you are effectively using leverage to get into more shares because you're foregoing that debt repayment ability in favor of putting it in the share market. The next layer that I can think of is that you could buy shares in companies that have leverage themselves. They're using debt to amplify their own activities. And so you're buying into them, and you're not using leverage to buy into them, but they are. And so you are kind of exposed to some leverage as well. And there are other sort of products out there, other types of ETFs, which are actually specific or explicitly using leverage. So there's a couple of different ways that you could think about this. But the other option, which I wouldn't recommend necessarily, is that you could go to the bank, and if you have a mortgage, top up the mortgage and put it into the share market. Please don't do that, anybody, but not without a lot of advice and a lot of careful planning. But it is actually possible in some situations to do that. And the bonus is that the interest expense is actually tax deductible. Yeah.
So I want to dig into that a little bit more, because I think that idea we just talked about before, should I pay off my mortgage before I invest in shares? And I'm probably one of the people, and again, this is just my opinion. This is not any advice for anyone else, because I deeply believe it is what helps you sleep at night. You should do. I bought a property with my sister recently, and we've decided that with interest rates as it stands, we are going to pay interest only on that mortgage, and we are going to invest all the rest of it in a very, very highly diversified fund, because we know we can lump sum at any time. So we can, and if interest rates change, so we are kind of doing that. But one of the sticking points for my brain to get into this, and I talk to my sister, she's probably watching. I always mention her. She's the financial guru in my life. I have a brain blocker that leverage to invest in shares is more risky than leverage to invest in property. But yet I look at funds like an S&P 500 fund, which spreads my money across the 500 biggest companies on the US share markets. And basically, if they all went under and that fund stopped to exist, it would be such a catastrophe that, that I don't know if we're right on that perception, and again, it sort of goes back to is it property versus shares, or is it I wouldn't use that mortgage money to invest in Tesla. I wouldn't, because that feels quite risky, because I'm putting all my eggs in one basket. But do we need to change our perception of something like investing in the S&P 500 is as risky or less risky than buying a property?
Well, you've got the diversification piece, right? Which I think you alluded to. So with the Tesla versus the S&P 500, what's the likelihood that all of those companies in the S&P 500 will actually go to zero? Pretty much nothing. And if it does, we probably have bigger concerns to worry about. But it kind of speaks to this whole volatility piece. And that's why I think it's not necessarily the norm, and it's not standard advice to do this, because shares are just so much more volatile in general. Like some are more volatile than the others compared to property in general. And so you really don't want to be left with the mortgage, but then be left with an asset that's worth far less than what that mortgage is.
Absolutely, unless you're in a position that you can hold out on that and have another 5 years for it to recover, which would potentially be the same with property. So on that front, then if you are someone who feels that is the case, that you are happy to sort of consider maybe that level of diversification is worth leveraging to buy shares with. There's the compromise between those trading platforms that allow you to borrow to invest, and funds like what we have on Hatch, where they can, is it twice the returns of the S&P 500, that triple Q, or I think even the inverse returns. So there are options available for that. But you did mention just now volatility, and that is another common perception. Share prices are more volatile. And I'm going to answer this one first. Is it easier for share prices to drop? Because that's sort of what you alluded to. I think property prices change every second. My theory is every time someone walks past my house, the price changes, because that person is willing to pay a different amount for it. I also think there is a limit to how much property prices comparatively can go up, because I look at New Zealand, and there's been a few questions about the recent law changes. But I do not think anything is going to solve our property crisis other than having enough properties to go around, which means when we have enough properties to go around and people can have a batch in a property, if we get to that state, there is a limit to how much a property in this country will be worth. Whereas, in my opinion, there is no limit to how high a property company can grow, the value of the company, even if it gets split and all that sort of stuff. So volatility, again, is that the right question? I'm giving you a very long question. Or do you believe that it is actually more stable to invest in property?
So which question should I answer then?
Just start rambling like I did.
Start rambling like you did? Okay.
We're only this far through our wine.
Yeah.
Darcy made me drink because he's like, you're doing wine and wealth. It wasn't my idea.
And I don't normally drink, so I'm already off the charts after 2 seconds. So if there's a couple things, right? Like every time someone walks past your home, the price changes. You're probably absolutely right, but we never know that, right?
No,
because it's such a friction-filled process to actually test that, and no one really wants to pay real estate commission to sell the property all the time, right?
Disagree on the sense of having bought a batch recently. Property prices changed quite quickly over the course of going to a couple of open homes over a couple of weekends. So there is friction. Yeah. But I think that real estate market can artificially decrease that friction by doing things like closed tenders and auctions to really ramp those.
In seasons, but with holiday home destinations, that's probably another topic right there, right? Because of that's definitely cyclical. But if you did know just how fast your property was changing in value, and it was really easy for you to dispose of it, I think that's a concern, and that's probably my biggest beef with the likes of online share trading platforms. As I'm not quite sure if you're involved in one or not, but
no, we don't. We're not involved in a share trading platform.
No,
we're involved in a wealth building.
Thank you very
platform.
much. That was a test, and you passed that. So that's the thing, right? Like you can see the value of your shares go up and down, and it's more, again, not what the investment is, but it's about what it does to us. So for a lot of us, if we see the up and downs, we may react in a way which is counter to our best interests. We might actually buy high and sell low. And if the platform that we're using makes it really easy and tempting to do so, then that's actually a real risk. With property, we don't have the same type of risk, because even though it is going up and down in value, it's not as apparent. And sometimes there's a certain sort of inertia around selling it, right? If we do feel panicked, hopefully maybe the interest rates will drop in that environment, and we might hang on and we might not have to test it.
So that sort of proves both our points that it's really not about the investment option; it's about human emotion and what you're going to be able to do. Because I don't know if you know anyone who does this, but I do know a lot of people who own their own home only, and they're constantly checking the price of it and celebrating when it goes up. And I'm looking at it going, yeah. Moving on, because we're 22 minutes to go. I know time flies, doesn't it? You always think we're going to have not enough to talk about. Which one's easier to research?
Whew. Well, I like shares for this because the information, and it has to be publicly available, right? So, and there's certain standards around the quality of the information. So I know that it is easier in the sense that the information is available. Sometimes it's not easy though, because we don't want to do that because we feel like it's only what smart people do, right? It's only what those people do who are really into that sort of thing. Property, little bit harder, I think, in my opinion, to actually properly research it because it's so hard. They're so unique. One property isn't the same as the other. And so even if you got a building report, it's hard to actually really rely on that report because that builder hasn't actually crawled inside the walls and the roof and everything. They're never going to really fully know what that thing is. Whereas with shares, it feels like, well, a lot of it is really just financial. And you can look at the micro and the macro, but you can see it. It's quite accessible to all of us. So I'd say, point definitely made for shares in terms of the ease of ability to research it.
I agree. I think I don't know, one job opportunity. I think if I was younger now, I would totally get into a trade. I think you get the double whammy of being in a completely swamped market where you will just get whatever work you want to get, but also you'll have the skills to be able to research property.
Like a builder.
Because man, like walking into a property when you're expecting to lay down all that money and you realize how little you know, and the costs of actually doing that research are really high. So I agree with you completely. It's shares, which is funny because I think that's counter to what most people think. And I think exactly your point. Again, it's about the approach we take rather than the investment. That for some reason, when it comes to property, we'll walk in and go, feels like home. Right. I don't care that all the windows are leaking with air and there's no insulation and that the kitchen needs changing. It feels right. But for some reason, when it comes to shares, we have this really weird feeling about, even if I know and love a company and buy, I talked to someone a while ago, she religiously buys Apple products, and it never occurred to her that she could invest based on not that feeling, that quite logical feeling of, I know how well this company does. I understand what they do. But she would have done it quite in a snap for property, which is, and sorry, just seeing that we've got 20 minutes to go. Okay, so this is one of our pre-questions, and I'm seeing all these other questions rolling in, and so we're trying to hurry. Yeah, there's some good ones, and maybe we'll stop after this one and switch to these. Yeah. People often talk that you should own shares for 10 or more years. Is that the same as property? What would be your is it better to own property because it takes, you have to hold it for less time?
This is a great one. Like I think it's probably a good reminder that none of this is financial advice, and please, anybody who's kind of wanting to make some decisions, please do get your own advice around this.
Absolutely.
And my opinion is that at least 5 to 7 years, right, would be the minimum period of time that you'd want to hold property for. A little bit less than shares, just because of that volatility piece. You really don't want to own any investment and think of it as like a bank account that you're putting it in, and hopefully you'll get a gain, and it only ever goes up, so we'll just sell it if we need to. It's probably a recipe for disaster at some stage. But I think that with what's happened with the tax stuff, which we might have time to go into, probably not, but with what happened with the tax change this year around the bright line test, aka capital gains tax for property investors, we now are going to be taxed on gains that we make on investment properties within a 10-year period. So there is now an incentive to hold on to properties even longer. So rolling that into it, I'm actually starting to say now that it's probably wise to consider holding things for 10 years with property and shares now for slightly different reasons. But one of the big ones now is because of the bright line test.
I mean, I agree, and I don't need to do too much more on this. The only other point I would make as a property investor is don't flip property if you don't want to put the effort into making them better. And as someone, I've gone to so many open homes where you go in and being like, this is a brand new bathroom or a kitchen, but it was just such shoddy quality that if you want to be a good landlord, you'd have to rip it out anyway. It ends up in the landfill. That's just an ethical thing. Should we switch to some of these? And I know there's a ton of them, and I think some of them we might get to. I'm just going to scroll up to the top. There's a few. Will we see intergenerational mortgages in New Zealand?
Yeah, I'm not entirely sure what the question there that James has posed, I'm just assuming though that will it be likely that your parents will pass away with a mortgage? Is that?
Yeah, I think maybe that's what it is, just because of the price of properties.
Yeah. Maybe is the answer, right? But it's not simple to just transfer that mortgage on to the next generation, right? Because that next generation has to apply for that mortgage.
I would say we're also probably going to see difference, maybe less of that and more of a change in how we own property. And I think you suggested that as well, fractional ownership of property.
Totally.
I mean, it wasn't very long ago, it was 3 years ago, where fractional ownership of shares wasn't a thing.
That's right.
I think that the idea of how we buy and live in properties is probably going to change.
Totally. And there's also other products out there that already exist that are kind of like a little bit taboo because people don't like the name of it, but reverse mortgages might be tools that people use that kind of almost justifies, I guess, using your own home as an investment vehicle, because then you can actually draw money in retirement and invest that by using this reverse mortgages. Again, not financial advice. I'm going to say that 1,000 times.
Yeah, we just keep saying it, but it's true. And we absolutely don't think you should listen to anything we say and blindly follow it. Okay, I'm going to go back to this. We'll flip between them. It's 15 minutes to go. I did mention before ethics. Yeah. Ethically, what is a better investment? We have a property crisis in New Zealand. Companies aren't necessarily known for having great ethics across the board. Which one wins on this one?
I love this question.
So just a simple 1 minute on this one.
Okay. Well, so if a property investor buys a home and rents it out to a tenant, are they unethical compared to a government who does the exact same thing? That would be kind of like the starting point, right? So who's better as a landlord, a private individual or a government? And a private individual armed with really clear and robust rules around standards around creating a good product, a good rental property. I've met so many property investors who are extremely ethical and they treat their businesses, which they are, very seriously. And they do it because they actually have a genuine desire to provide something for families who can't afford to own their own home. My view is that that's a natural response. That's a natural thing to do. You're trying to build wealth, but you're also doing a good thing. There's no misalignment between values and wealth building strategy right there. That's my view. I completely agree. I think, and it boils down again, not to the investment, but to the investor. It's how you approach it. I think it's the same with companies. And we have done a webinar, which if you haven't seen, you should go and watch. It was a goodie on ethical investing, and Kristen and I talked about it for an hour, and I had learned so much in the lead up to it when it came to shares is yes, companies are, like, by nature, I mean, don't they call them psychopaths? They're designed to sort of maximize revenue and returns to shareholders, but that is changing as well. And I think that's one of the joys of the everyday investor movement, that more and more people and as with property, when you can invest in that and have an impact on housing someone, and there's always going to be people, I think, like, I just was, to me, it's an artificial debate, and I don't know who benefits from it, but I can think of a few people to say, it's boomers versus millennials or whatever. We just don't have enough property. There's no lack of ethics in that. There's just not enough property. And I think it's the same when it comes to companies. You have the opportunity to invest in a company that you want to grow. Yeah. So that is another flip side or side effect of investing. When you invest in a company, you are backing it, and so by making decisions around your ethics and which companies you invest in, you can sway the companies that get the money. And if no one's investing in oil companies, where's the money going? That is legitimately a thing. Let's talk performance before we jump back over to those ones, just because there's a million. I'm stressed. Which one has historically given better returns? So this is another one where leverage does muddy the waters, right? So in terms of returns, if we're talking about the return on your capital, and you're using leverage to amplify the market, then property wins every day, right? But if you're not using it, like if you had $1 million to invest, someone died, hopefully. Well, what am I talking about? Not you, but someone dies.
Investing.
Yeah, that's right. Someone dies and you don't get caught killing them. But if someone dies and gives you $1 million and you decide to put it all in $1 million property versus $1 million of a diversified share portfolio of shares every day. But in reality, depending on your age and stage and who you are, you might decide to put a little bit into property and then take out some leverage, take out some bank debt, mortgage to fund the balance of it and then invest the rest. And then in that situation, property actually totally kills it. But then thinking about it holistically as an overall portfolio with your investment property and your shares, that's the ultimate. So
I suppose if you're investing money that's not yours, if you are not paying back your mortgage and using that to buy shares or whatever you're doing is going to have a better. But I think for me, that's not the question all the time. Because we talk a lot in shares, and I don't know if they talk about it so much in property that past performance is not an indicator of future performance. It's almost a cliche. You hear it so much. I would say that is a better question when it comes to historically what has given the better returns. Because historically with property, in my opinion, there is some changes are coming. Like if we have enough houses, which hopefully we will one day, that may have an impact on, I mean, I think it was in the last 12 months, I talked to a very, very helpful man from CoreLogic the other day to get some stats. Thank you. I hope if you're listening. And over across the country in the last year, it's been something like 20 to 35% average growth in house prices. Yeah. But one little tidbit he gave me, which I think is really fascinating, and that Christchurch proves, is as part of the rebuild of Christchurch, new quality houses were built quickly. And what that led to, which I was shocked to hear, is in November 2019, Dunedin overtook Christchurch for average house price. So in my brain, that sort of shows that when you have a supply of housing and it's been built quickly and is available, house prices will stabilize. And so I think rather than talking about historical, because I agree, if you leverage and you borrow money to invest in anything, you're going to get better returns. But will property go up in value as much in the future? I don't know. I do not know. Do you know?
Well, rising supply is actually the biggest enemy, isn't it? But depending on what battle you're trying to fight, right?
Yeah.
If it's the housing prices, supply is clearly the ultimate solution. It's not trying to stem the flow of demand. It's about increasing supply so the free market can do its thing. But yeah, I think that it's a very interesting way of looking at it. Like you're looking at it from the perspective of, well, what about the risk associated with oversupply, right? Because if I put the money in the property and then there's incentives for more development,
which they're coming out, right?
Totally.
All these laws are trying to,
So that's and to be honest, that's probably one of the first times that I've heard it framed like that. That I guess that is a genuine risk, that if you're buying new into an area which is currently experiencing a lot more supply, then potentially you're going to have a lower or a longer time frame to actually see that come to fruition in terms of getting some good gains.
And I just think that's because this has been quite a few people were asking about this, and it does make you think. It does make you think, and I think yes, I saw that question. Should we move to that, because it's literally we've been ignoring the question because we have it down, but let's do it. And I'm going to rephrase it. If I haven't yet bought my first home, what's my best option?
Great question.
Apparently everyone's been asking it. So good we picked it.
Yeah, and it's a question that I've heard many people ask, right? So it's really important that I think we acknowledge the fact that buying a home is actually a good thing to do. It's a good thing to own your own home.
I love owning my own home.
Good. And then by extension, it's actually a good thing to become a property investor. That's my belief, right? So
agreed.
Okay, fantastic. This is a great debate so far. We're all agreeing with each other. But the question is then, well, what do we do on the way to buying our first home? Like, how do we actually save for it? Because it feels like we're not actually even being able to, and you're not able to actually keep pace with the housing inflation rate, even just with that 20% deposit.
Yeah.
And so there is no easy answer here, but I think giving up is not the answer either. I think still trying, still aiming for it for the right reasons, aiming for it because it's a good thing to pursue. It will force you into becoming much better with your money. You'll be a lot more disciplined. You'll have savings targets. Where you put that money, really, well, you've got a lot of choices, but I would go back to what's the minimum time frame required. And while it's not ideal to invest in something for the sole purpose of cashing it out within a very short period of time, like less than 5 years especially, you don't know when you're going to be in a position to buy a home. And given where the property market is going, let's assume it just keeps on trucking along. Who knows? But still, you should be aiming for it. And one of the coolest ways that you could do it, and you have to be really thoughtful and careful around this, is to invest in a well-diversified, balanced way, depending on what your time frame is, what your expected time frame is in the share market. But you want to do that via a lot of diversification so that you'll minimize the chance that you're going to get nailed if you decide to cash that in a lot sooner to pay for your deposit, because you're kind of losing a little bit of control and you're at the mercy of the equity markets now. That tells you when you're allowed to buy a property. And if that's decided to have a bit of a tanky moment, which it could
The
totally
tinky
do.
moment.
Yeah, we all have our tinky moments every now and then. And if that happens right when you found your dream home, that kind of sucks. So you do have to be really, really careful when you're investing. And as boring as it is, if you have a time frame of less than 5 years, pretty wise just to consider the boring old savings account.
I have a lot of thoughts on this.
Cool.
I think exactly what you were saying about that 5 year thing. And I don't know when it ever felt possible to buy a house without 5 to 10 years of saving. I don't know if there was a time. It wasn't in my time. I feel like you had to put in the hard yards.
When you could save for a 5% deposit instead of a 20% deposit,
yeah,
it was kind of possible.
Yeah, and I feel like and so it feels like it's been well and truly gone. My feeling is a couple of things. I agree, it is really nice to have a house. I also think that the reality of the world as it stands is you either have to be flexible on time, like you said, and actually acknowledge it and just say, if I am going to put all my money in this well-diversified fund, and that means that I could hope to, if historical returns are no indication of future returns, but that might continue to grow by the share market average, which has historically been 10% a year on average. But yes, it might have a tanky moment. So I just have to at any point go, I'm giving up on the idea that I can buy the dream home the moment I want to do it. I could decide to do that for 4 or 5 years and then get to a point that I feel like my money's grown and now it's safer to take it out and leave it in a bank because I'm thinking I'm a couple of years away. My suggestion would be, as soon as you sort of feel like you are getting desperate, but then I would say that's a self-sabotaging moment, because when it's in the bank, it's not growing. So you really, I would say if you want to buy a house and you've got in a position that you will not be able to save your way there, you have to give up on the time frame and just, but I've got one hot tip that Nick from CoreLogic told me that people may know, but I don't. But a secret, before I give you that, I'm going to keep you going on KiwiSaver, which we keep hearing a lot about. KiwiSaver has made it much easier for first home buyers to get in, because, by the way, first home buyers have been increasing in numbers since 2017. More people are buying their first homes now than before, and a lot of that's put down to KiwiSaver. And one dot connection that I think gets missed is all KiwiSaver is. It's not magic. KiwiSaver has just taught us that if you put aside 6 to 8% of your salary every year, which is a lot of money, but 3%, you get the free 3% from your employer, for a decade or so in a fund, you will save a house deposit.
Amazing, isn't it?
And even more fascinating is if you're in a balanced or growth fund in your KiwiSaver, you will have a large portion of that invested in shares. So people are already, if they're using KiwiSaver, using the share markets to save their deposit. That is happening. You can replicate that by adding more to your KiwiSaver, or you could look at doing that outside of KiwiSaver, and you are doing exactly the same thing. And as with KiwiSaver, which a few people found at the beginning of lockdown last year, where the share markets took a dip, and there were a few people I knew who were looking to buy a house using the KiwiSaver, they just had to hold off. So I would say we've already got an analogy for that, and it's already working. And the hot tip, which people might know, but I was really excited to hear it, is 20% of all new lending from banks to owner-occupied properties can be less than a 20% deposit. They can be. And this is something that no one I knew, that if you are someone who is on a good salary and you have a somewhat of a deposit, talk to a mortgage broker. They are a free service. Talk to a mortgage broker and see what your options are, because you may be able to get into a property with less than a 20% deposit, and that's kind of life changing. You've suggested there's a limited supply. There is. It's 20%. But even if you have to pay a slightly higher interest and you get that, you're not paying rent anymore. So you've got that. Yeah. So there's something there too.
There's something there, and I think it just goes to show that it's not so much about following hot tips and tricks. It's about having a strategy, and it's about aiming towards a direction that you believe is a good direction. You might not necessarily be able to control everything, so that's why I think it's really important for everyone to realize that it's about just aiming
something's got to give.
Yeah, something's got to give. Some things you'll be able to control, some things you won't, but what you can control is you can control where your net or where your surplus income goes. And KiwiSaver, like you say, and then scaling that up with some other non-KiwiSaver investments and other funds. It does make sense, but I think everybody just needs to kind of just stop looking for the tips and tricks and then
do the work.
Yeah,
do the good money habits. And KiwiSaver has taught us that.
Totally, yeah.
Regular amount every month, every week, put it aside in something that grows.
Yeah.
One final one, and given the recent tax changes, I mean, I'm going to answer this really quickly. You might have a follow-up.
So the question is given the recent tax changes for investment properties, are investment properties still a good investment?
When I've looked at some of the stats that have come out and talking to Nick from CoreLogic, there's no change. There's no change in the number of people who are investing in them. So I would say yes, they were as much as they were before.
It comes down to who you are rather than what the asset is, right? But I think it does take time for these things to actually show in the data as well. That would be the one thing that I'd suggest with these tax changes, that they are very significant. With people that I talk to, a lot of them don't actually realize or appreciate the impact on their cash flow. But people often, we're very simple. We look for very simple answers, very black and white, yes or no, up or down, nothing gray, thanks. But when it comes to this one, we've seen just a small increase in interest rates in the last 3 weeks with retail banks increasing their interest rates a little bit. I think, ironically, even though that's actually a smaller net increase to the cost of owning a home, that will possibly have a bigger impact than the far bigger impact that these changes to tax
True, because you can see it. You can see it, and then that probably proves it by us still asking the same questions.
Yeah.
I'm going to do one more question, even though we're 1 minute off, because we started a couple of minutes late. Yeah. If you want to bow out now. There's only one question to go. We've talked a lot about property versus shares. We haven't debated nearly as much as maybe people anticipated, but there is a world in which they come together, and that's a thing called there's property funds. They're called REITs, a beautiful name, real estate investment trusts. What are your thoughts on them as a way for someone who wants to invest in property, who doesn't necessarily want to buy a property as an investment option?
I think it's great. Like anything that looking at not necessarily the simple, obvious solutions where it's property, and if I can't do property, I'm going to do shares, and that's owning something in a company that's doing something that's not property related. Well, by the way, there's a lot of other investments that indirectly give you exposure to the property market. Usually it's, I think in New Zealand especially, it's always commercial property that you're getting exposure to. And there's some correlation between the commercial and the residential space. But there's a lot of clever ways of doing it. Real estate investment trust, one of them.
Which we do have on Hatch, by the way.
Yeah, and then there's index funds, and then there's listed properties, unlisted property funds. There's a lot of different ways, and they all carry very unique risks around that. But the beauty of it is that you've got diversification, which you don't have when you're the sole business owner of one property. Really, really important. You've got spreading out of all your costs and all your risks over different geographies, different property types. And you've got people that is their sole job is to run a real estate owning business. You've got to assume that they're going to do a better job than you are. And some of them will be using some degrees of
maybe you can assume. Well, no, I mean, obviously a self-directed investing platform.
Yeah, true.
It's just for anyone who doesn't know, REITs is basically a fund where they invest in like they literally buy properties and the properties are owned by the fund, and they generate cash flow like rent and that sort of stuff. Yeah. I would suggest they're a very cool thing because they force you to wonder to not do the black and white thing, but actually think through why you want to invest in property. Because if you are a totally logical person who's investing in property because it's the best investment, put your money in a REIT. Because investing in property, diversified, it's got all the benefits. You don't have to do the maintenance. And I suspect there will be a few people going, oh, but I just want a property. And I think that's a good note to end on, is probably a good point to stop and wonder why you want to do that and what the benefit of having. Is it a sort of emotional connection? Because, if you're purely thinking about the financial returns, Yeah,
that's right. We're bringing all of ourselves to all of our investments.
Yeah.
Right? So you have to be honest when you feel like I'm not really that excited about that. You got to ask the question, well, why is that?
Yeah.
Are you pretending to be analytical when you're really emotional?
Yeah.
Or the other way around?
Absolutely. So on that note, thank you for joining me, Darcy. Thank you for letting me into your office. Look, we've timed our wine. We didn't stumble too much. Sorry for the technical issues at the start. Thank you so much for all your questions. Now I think we're going to need to do another webinar on this. You can follow Darcy on Instagram at, look at this, at New Zealand NZ Everyday Investor.
Yeah.
And you can check out his podcast, which I'm not going to say that.
No, just go to NZ Everyday Investor.
Yeah.
Or go to Spotify. Just go to Spotify.
And thank you everyone for tuning out tonight. It was so awesome to hear. This was a record-breaking number of registrations for this. Very exciting, and we will be back with more webinars, a lot more webinars.
Cool. Sounds awesome.
Have a good night.
Cheers.